The world of finance, it can feel like this impossibly complex maze, right? All this jargon, these huge numbers, a system that just seems built to be confusing. But what if the entire thing, every bank, every stock, every single trade, is all built around one single powerful idea? Well, today we're going to track it down. Let's get into it. So I want to start with a question for you. What is the single most important commodity in all of finance? Now, your first thought might be money, or maybe gold or stocks, but it's actually something way more fundamental than any of those. The answer is risk. That's it. The whole global financial system is just a massive, incredibly complicated machine built to do one thing: manage, price, and trade risk. So here's the secret. If you can understand risk, you can understand finance. It's the key to everything. Okay, so who are the main players running this giant risk management machine? Well, it all starts with the banks. But, and this is important, not all banks are created equal. Let's break down the three fundamental types you need to know. Now, what's so great about this breakdown is how it defines each bank by the specific kind of risk it handles. Just take a look. Up top, you've got central banks. They serve the whole economy, and their job is to manage systemic risk, the big stuff like inflation and making sure the whole system doesn't collapse. Then you have investment banks. They're for corporations, helping them manage risk in the capital markets. And finally, you have commercial banks. That's for people like us, individuals and businesses, and they manage credit risk. The risk that someone might not pay back a loan. So central banks are really the guardians of the entire system. Their goal isn't to make a profit, it's to keep the economy stable for everyone. You can think of them as the ultimate backstop, using their tools like setting interest rates or managing the money supply to fight off huge threats like inflation and unemployment. Investment banks, on the other hand, they're the deal makers. They're the ones helping giant companies raise money by underwriting and selling stocks and bonds. They're helping with huge mergers, and they're creating all these complex financial products. They really live in the high-stakes, high-risk world of the capital markets. And then, of course, we've got the banks that we all know and use, commercial banks. They're pretty straightforward. They take our deposits and then they use that pool of money to give out loans for cars, for homes, for small businesses. They're basically the credit engine for the everyday economy. Okay, so we've met the players. Now let's get into the game itself. We need to really understand the specific dangers, these specific kinds of risk that they're all trying to manage. Think of this as your field guide to financial risk. First step is market risk. This is the classic one, right? It's what everybody thinks of. You buy something, a stock, a bond, whatever, and its price goes down. Simple as that. It's the fundamental risk you take on when you own pretty much any asset whose value can change. And this is a perfect illustration of how that works. Let's say you buy a bond and it pays you 3% interest. But then the central bank raises rates and new bonds are suddenly paying 5%. Well, who's going to want your old 3% bond? Not as many people. So its price on the market, its resale price, is going to drop. That is market risk in a nutshell. Now, this next one is a little more subtle. It's called reinvestment risk. So imagine your investment is over. Say a bond matures. You get all your money back. Awesome. But the problem is interest rates in the market are now way lower than they were. So you have to reinvest that cash at a much worse rate of return. It's the risk of losing out on future income. Then you have default risk. Some people call it credit risk. This one is simple but powerful. It's the fear that you loan someone money and they just can't pay back. It's the absolute core risk of any kind of lending, from a credit card to a government bond. And finally, we have to talk about inflation risk. This one is the silent killer of wealth. It's the risk that even if you get all your money back and you even get some interest, that money can now buy you less stuff than it could when you first invested it. And this example makes it so clear. Let's say your savings account paid you 3% for the year, but during that same year, the price of everything, gas, food, rent, went up by 8%. You didn't actually make money. In terms of what you can actually buy, your purchasing power went down by 5%. That's inflation risk just eating away at your savings. So we've seen the players and we've seen the dangers. But what happens when the management of all these risks goes horribly, catastrophically wrong on a global scale? To really get that, we have to look at the ultimate case study, the 2008 financial crisis. To understand the crisis, you really have to look back. For decades, there was this law called the Glass-Steagall Act, and what it did was build a firewall between the safe, boring world of commercial banking, our deposits, and the high-stakes betting of investment banking.
But as you can see on this timeline, in 1999, that wall was torn down, and less than a decade later, the whole system just imploded.
Now, this is where there's a huge debate, and it's still going on today. One side argues that getting rid of that law was the original sin. It let commercial banks take on all this crazy risk that they never should have touched, which led directly to the collapse. But the other side argues, wait a minute, the biggest firms to fail, like Lehman Brothers, they were pure investment banks. They say the repeal wasn't the real problem, it was other things, like housing policy, that pushed all these bad loans. It's a really complex debate with no easy answers.
Okay, so with all this risk being managed, and sometimes clearly mismanaged, where does the actual buying and selling even happen? Well, it turns out it basically happens in two very different kinds of marketplaces. So on one hand, you've got exchanges, like the New York Stock Exchange. These are centralized places. They're transparent, you can see the prices, and they're highly regulated. The exchange itself actually guarantees that the trade will go through, which solves that credit risk problem we talked about. But then, on the other hand, you have over-the-counter, or OTC markets. This is totally different. It's a decentralized network where people just trade directly with each other. It's way less transparent, and you have to trust that the person on the other side of your trade won't default. And here's the crucial point. Even the design of the marketplace itself is a form of risk management. An exchange is built to solve credit risk by putting itself in the middle of every trade. An OTC market, though, prioritizes flexibility. They're just different technologies for managing the fundamental risk of a transaction. And that brings us right back to where we started. The three kinds of banks, the different types of financial danger, even the very places where trading happens. It's all one giant, interconnected system, and it's all designed to do one thing: to price, package, and shift risk from the people who don't want it to the people who do. Which, of course, leaves us with one last big thought. We keep building more and more sophisticated tools to manage risk, but it seems like the system always finds a way to face new and scary crises. So as finance gets faster, more global, and way more complex, is a truly safe system even possible? Or is risk just something we can only ever hope to manage, but never, ever eliminate?